Good evening, folks. We're going to get started in just a second. There's people still trickling in. We'll give them one more minute and then we'll get started. Okay, I think we're set. We're all set. I'll keep looking to see if there are more people joining us and I'll bring them in as they do. Good evening, everybody. I'm Luann Beninati from Let's Grow Kids, and we're happy to be supporting this session along with First Children's Finance. I see Erin Roche from First Children's Finance is here joining us, and a partnership with them and the Vermont Small Business Development Center, where we have been offering a series of sessions to discuss business-related topics in preparation for the full implementation of Act 76. Tonight's presenters are from the Richards Group. We have Jessica Jacobs and Steve Burnett here to talk with us. They have a presentation. I'm going to hand it right over to them in a moment to let them introduce their organization and what they're going to talk about with us. And before we do, a couple housekeeping things. I'm going to ask everyone to please stay muted. We'd love to have you on camera if you are comfortable. If you're also having dinner and would like to be off camera, that's fine too. There will be time for questions during and after the presentation, and so please feel free to use the chat box to put the questions in chat. If we get to the end and there is time for discussion, it is a small enough group that we'll probably just suggest that folks raise their hand and we can unmute. But in the meantime, use the chat box for questions. This is approved for Northern Lights credit hours. If you would like the hour-and-a-half credit for Northern Lights, two things. One, you must stay on for the full hour and a half. And also just go ahead and put your BFIS number in the chat, and I will make sure that it gets submitted for hours to Northern Lights. And I think that's it. This session tonight is to talk about benefits for staff in programs with more than one employee. Next week on Tuesday night, next Tuesday night at 6 o'clock, we are also offering a second session that will be primarily focused on family child care and programs that have one employee, just the family child care provider, so no employees. So, but this one tonight is to talk about childcare businesses with employees. And so on that note, I'm going to hand it over to Jessica Jacobs and Steve Burnett from the Richards Group.
Thank you, Luann. Okay. Let's see if that works. Can you all see my screen now? All right, let me just bring over my view. So hi, everybody. My name is Jessie Jacobs. I am with the Richards Group, as Luann had mentioned. I'm an account executive and manager of our Select Business Unit, which services mostly groups of 50 employees or fewer. My email's right there. These slides will be going out so you don't have to take notes furiously as we're going through the slides. I spent about 14 years at Blue Cross and Blue Shield of Vermont working in small group, and then I went to Vermont Health Connect for a couple of years until I landed here and have been here for the last 5 years. So I have a lot of product and plan knowledge, and I can speak to Medicaid as well as the exchange plans sold in Vermont. And also joining me is Steve Burnett. I'll let Steve go ahead and introduce himself.
Hi, everybody. Steve Burnett. Again, I am the retirement plan consultant for the Richards Group. I have spent my entire career either in employee benefits or in 401k consulting. So I'll be sharing some of the various options that are available for small employers with respect to saving for retirement for yourselves as well as your staff.
Great. Thank you, Steve. So did it advance to the group versus individual slide on your view? It did. Okay, good. Sometimes that doesn't work. Okay. So in Vermont, there are basically two markets. There are, and we have 50 or fewer employers, and this is specifically looking at health insurance only. So is the group market and there is the individual market. When Vermont decided to implement the Affordable Care Act, the Shumlin administration was in charge, and they saw that as kind of a stepping stone towards a single payer system. And so part of that strategy was to force all of the small businesses and individuals that were getting their insurance directly from the carriers to purchase one of the qualified health plans on the exchange. Originally, the Vermont Health Connect was supposed to enroll groups. That has not happened. The technology just they couldn't build the technology in time. And so they handed that back over to the carriers, but they remain in control of the qualified health plan designs, the plans that you have to choose from out in the market. And then the Department of Financial Regulation is monitoring those rates and after a rate review process. So there is a limited options in Vermont. There is basically purchasing a qualified health plan through either Blue Cross or MVP, through Vermont Health Connect. Essentially, it's just that you're working directly with the carrier, or there are level funded plans, which are options really for employers that have at least 5 enrolled. They tend to work better when they have 10 employees enrolled. They're a little bit more complex, and I'm happy to have that conversation offline. But for employers starting out with offering group medical benefits, the Vermont Health Connect exchange plans is usually the first place that we will look. In 2021, the state separated the small group market, which is small businesses, from the individuals. And what this resulted in 2 sets of plans. So there are 13 plans that small businesses can sponsor for their employees through Blue Cross or MVP. And those same exact 13 plans also exist for individuals. However, the rates are different. So I kind of did a comparison in preparation of this. The last time I looked, the individual rates were about 15% more expensive for the same exact plan. When I did this analysis yesterday, it has jumped to 25% difference. So if you or your employees are getting their plans on the exchange as an individual, it may make sense to look at what it would look like offering a group sponsored plan, because right off the bat, you're going to save 25%. For the same exact plan. And we do expect these markets to be separated kind of indefinitely. But I think the way that the regs are written, they have to review it again before the end of 2025. So here are kind of some of the requirements to offering a group sponsored medical plan for your employees. So if you're a small business and you've never offered group health benefits before, you can do so at any time. You just come on at the first of the month, any time of the year, and you begin offering benefits. Most employers will begin on January 1st because most employees' health plans also run on a calendar year basis. And so anything that an employee has kind of accumulated towards their deductible and out-of-pocket maximums, if they were to leave their current plan and jump on your plan, they would lose everything that they've incurred to that. And they would start with a fresh plan. And then come January of every year, everybody's deductible and out of pocket would reset to 0 again. So it makes the most sense if you are going to start offering group sponsored medical benefit that you do it, in alignment with the calendar year beginning January 1st. Because the exchange plans are the only plans available, the ACA requires that you offer it to anyone working 30 hours or more per week. That is kind of their definition of full-time. If you wanted to extend coverage or allow employees working fewer than 30 hours a week to enroll on your group plan, that's totally fine and up to you. And you can contribute different amounts of premium to employees working 30 or more, or 29 and fewer. One thing that's kind of surprising when we talk to employers that have never offered coverage before is that there is no minimum contribution to premium required. So you can just make it available at 25% discount. But when we work with clients, we like to see the employers kind of engage in offering kind of a benefit of value. Because when you offer group sponsored insurance, the federal government sees the part that you're contributing as the subsidy. And so any of your employees that may be getting their coverage on the individual marketplace through Vermont Health Connect, and receiving a subsidy would no longer be eligible for that subsidy, because the government is saying you, the employer, are now getting that subsidy. And there are some exceptions to that rule. It's about affordability, and I think we're going to get into that in the next slide with a little bit more detail. Another great thing about sponsoring group medical coverage is that there's no minimum participation. So if you were a small business with 5 employees, you only need 1 of your 5 employees to enroll in order to offer that group sponsored plan. Then you can enroll. But as the business owner, you cannot be the only one enrolled. So if you are looking to provide coverage for yourself, you'll need at least one other employee to enroll on the group plan, because you can't be the only one there. And then just some logistics about how this works, since it may not be commonly understood. So you are sponsoring the group plan, and Blue Cross or MVP is going to invoice you prospectively. So they would send you ideally an invoice in early December for January's month of coverage. You're going to pay the entire premium to the insurance company, and then you're going to withhold the employee's portion of premium, whatever that may be, on a pre-tax basis from their paycheck. And then if you do have employees who are on Medicaid, they are completely unaffected by your decision to sponsor a group health plan or not. Medicaid is solely determined based on income. And once they are approved for the Medicaid coverage, that they are kind of guaranteed that Medicaid coverage for the next rolling 12 months. If they were to earn too much money to put them over those income limits, then they would get a notice letting them know that they're no longer eligible for Medicaid. That counts as a qualifying event, at which point they can enroll on the group plan that you offer. So the other considerations, just want you to be aware of, is that employees that have access through their employer, so if you decide to sponsor a group plan, your employees who are getting their coverage on the individual exchange through Vermont Health Connect and receiving a subsidy, in most cases would no longer be eligible for that subsidy. The affordability, there's an affordability test that applies here. So if the portion of premium that the employee has to pay for self-only coverage, so just to cover themselves, what they have to pay, what you've told them they have to pay, you're paying portion, their portion, if that exceeds 8.39% of their household income, which you may not always know because you don't know who is in the household, then the Vermont Health Connect says, okay, the plan that your employer has offered you is deemed unaffordable. So we're going to allow you to enroll on the exchange and take whatever subsidies that your income says you're entitled to. So for most of the clients that we work with, because we ask our clients to contribute at least 50% of a bronze plan, that helps to kind of mitigate any of these affordability issues. It's a richer benefit than what they can get as a subsidy on the individual market in most cases, and is kind of value to the employees, and then is kind of a retention tool or a recruitment tool for hiring and retaining great employees. When you start offering group benefits, especially medical benefits, there are new federal and state regulations that apply. So there are things like a premium only plan document. If you're going to withhold the employee's portion of premium on a pre-tax basis, you need to have this document on file. The document kind of outlines the rules around your group health plan, the eligibility, when employees are eligible to enroll, when their benefits end, if they leave employment, and it kind of puts it all in a document just to have on file in case you're ever to be audited by the IRS or the Department of Labor. They're going to want to see that you're following the rules associated with withholding premium on a pre-tax basis. The other thing that you would have to follow is that COBRA does apply to any small business offering a group medical plan. And so COBRA is the right to continue your benefits if you leave your employer. It is mandatory for medical. It is optional if you offer dental and vision and they want to continue those. Most of our small businesses self-administer this. And that's kind of one of the perks about working with a broker is we will help guide you and let you know what you need to do if you have an employee who's leaving employment. There are notices that you have to give them. And then if they want to kind of exercise their right to continue that, they can do so, assuming that they pay the full premium of the plan. And then there are limits to how long they can stay on the plan, so on and so forth. And then there are just standard compliance notices that are typically given out either when they initially enroll or once annually. These are all the kinds of services that working with a broker will help kind of manage for you and guide you along the way. Otherwise, you would have to kind of navigate that yourself. So these next two slides are this. The first slide is the standard plans, and the second, actually, I only included the standard. So there are 13 plans in all. These are the standard plans, and really standard only means that they are offered by both Blue Cross and MVP. And when the Affordable Care Act was put in place back in 2014, the state of Vermont really kind of designed these plans. And they said, Blue Cross and MVP, you want to offer these plans, you have to offer them exactly how we've outlined. So regardless of which company you're working with, Blue Cross or MVP, these plans are identical. The only difference is the rates. And I know that this is really tiny and small to read, so I did send it as a separate file that you can kind of enlarge later to get a better look at it. In the file that I also sent to Luann separately, page 2 has Blue Cross's non-standard plans, and page 3 has MVP's non-standard plans. And those are just plans that are unique to the carrier themselves. So they each have 2 gold plans, 2 silver plans, and 2 bronze plans that are unique to Blue Cross or unique to MVP. The other carrier doesn't offer them, but in terms of the richness of the benefit, they are consistent. The way that they've kind of categorized the richness of the benefit is in metal levels. So the platinum, gold, silver, and bronze. This describes the relationship between how much you pay each month in premium versus how much you're going to pay when you use your benefits. So what your copays are, your deductible, your out-of-pocket. And so the higher the premium, like on the platinum plan, that's the most expensive plan you can buy, it has the lowest out-of-pocket exposure. The flip side of that are the bronze plans. So these are the cheapest plans that you can buy, the least expensive plans, but you're assuming the greatest amount of risk if you need to use your benefits. I would say that most of our clients offer a silver level plan. And you can offer all of the plans if you want to, but they base their contribution to an employee's premium off the silver level plan. So it's the most populated plan. There's the most enrollment in these plans. And I would say that we have the most of our employer clients basing what they contribute towards the employee's premium on the silver level benefit. Okay. Moving on. So now there's a whole series of tax advantage accounts. This one is health savings account. So if we just go back really quickly, I want to call out something here. Whenever you see a CDHP in the title, see we have 2 on this page. And if you look down at kind of the services, you're going to see it's deductible, then deductible, then. There's deductible that applies to everything. These are called HSA compatible plans. And in return for enrolling in an HSA compatible plan, you get to fund a health savings account. So these are accounts that the employee owns. It's just like a regular bank account that they have, you know, their checking and savings. You can get one online through like Fidelity on, fidelity.com, or you can go and get one at your local bank. Some of these HSA accounts have investing options. Some of them have monthly fees. So, if you are interested in a health savings account, then you'd want to kind of look into those details. And money can be contributed by both the employer and the employee. So as long as you're in one of the compatible HSA plans, those CDHPs, then you as the employer and your employee can make pre-tax contributions to those accounts. The funds can be used for any qualified medical expense. So what that means is any copays, any coinsurance, any deductible expense, and also anything considered Section 213D, which is a section of the IRS code that kind of outlines all of the qualified medical expenses, which includes dental and vision and some other kind of outlier expenses, like first aid kits and things of that nature. So there's a whole exhaustive list of items out there that you can use these funds on. If you don't use your HSA monies on things that are considered qualified medical expenses, there will be a penalty assessed. it's a 20, there it is. It's a 20% penalty. The beauty about these accounts is that if you start them when you're kind of like young and healthy and not using a lot of healthcare, you can roll this money over. It stays with you forever. If you have an HSA bank that allows you to invest, you can put that money into investments and grow those monies tax-free. And then at a certain point when you turn 65 and you become Medicare eligible, you can use those funds not only for your medical, dental, and vision expenses, but you can also use those funds to pay your Medicare premiums later on in life. So this is a great kind of savings vehicle to put money into. The problem is the CDHP plans, those compatible plans, if we go back one page, when they were initially introduced, the premiums were significantly lower than what we call copay plans. So right here, this gold, the platinum, the silver 3, these are copay plans because they offer copays, flat dollar amounts for the most commonly offered services. Whereas the CDHPs, the HSA compatible, everything except for preventive care goes to the deductible. So if you pick a plan like this, you're going to pay the first $2,100 as an individual. If you're enrolled as a couple or a family, it's the first $4,200 out of pocket right away before the insurance company pays anything. And the only exception to that is preventive care and preventive drugs. So when these were originally introduced, the premiums were significantly lower by like a couple $100s a month. So the strategy was enroll in one of these plans, take that couple $100 a month that you're saving on premium and put it in your health savings account. Then if you don't need it, that money continues to roll over and grow. If you do need it and you have been saving diligently, it is there for when you need it. So the annual limits go up with inflation every year on how much you can contribute. So in 2023, it's $3,850 if you're enrolled as an individual, or $7,750 as a family, couple or family, and it is going up to $4,150 and $8,300 next year. And again, there's no limit to how much the account can hold. I would say about 10, 15 years ago, these were really popular with employers because they were saving on premium. Now the premiums for these plans are basically right around the same range as regular copay plans. Also, any money that you pledge to put in an employee's account is theirs forever. So that is something to take in consideration if you are ever to fund an employee's health savings account. That is money that you are promising to pay them. It is theirs. They leave you halfway through the year. Whatever you've contributed to their account at that point stays with them forever. So flexible spending accounts are very similar in that they also are allowed up to, it's pre-tax money that the employee decides to set aside for out-of-pocket qualified medical expenses. So it's the same thing as the medical, anything associated with your copays, deductibles, coinsurance, dental and vision expenses as well. But these accounts are employer-owned, but employee-funded. So it doesn't matter what plan your employees have. You actually don't even need to sponsor a group medical plan if you don't want to. You can just work with a vendor. We definitely recommend you work with a third-party administrator or a vendor to administer these plans because the charges have to be substantiated, which means they have to be validated that they were a qualified medical expense. But essentially how it works is you say, we're going to offer everybody FSAs. Employees can choose to have up to $3,050 withheld over the course of the year and funded into their flexible spending account. The FSAs usually come with a debit card nowadays. So if they're at the pharmacy picking up a prescription, they can swipe it and they are using their pre-tax money to buy their prescriptions. Don't have to be on your medical plan. You don't even have to sponsor one. You just need to find a vendor in lieu of. Both Blue Cross and MVP offer FSA plans. So if you're going to sponsor a group plan, you also wanted to offer a flexible spending account so that your employees could pay for their out-of-pocket costs with pre-tax dollars, that you could do that through either of the carriers. So the one caveat to these flexible spending accounts is that the funds are use it or lose it. So we want employees to be realistic when they are electing how much they want to put away. If they don't have $3,050 worth of medical expenses, or they don't anticipate that, then that money has been withheld from their pay, but they are not entitled to a return of it. So we usually work with employees to make sure that they kind of do their best guess and not over withhold. It's better to under withhold than over withhold because you're not guaranteed that money back. Although you as the employer may decide that you want to allow a rollover. So that means you can say the last $610 of your 2024 plan, FSA plan, you can roll over into the 2025 year. That's up to you. But if that's not an option, then those employees, whatever's left in their accounts as of the end of the year, and they don't have any claims incurred to submit for reimbursement for, then they're out that money. And you can also allow a grace period. So then this is pretty common. I think it's by default, it's 2.5 months. So I'd say if I had a FSA this year and I had $500 remaining, when I looked on December 1st and I wasn't planning on any other medical, out-of-pocket medical or dental or vision expenses, that's when I would be like, I'm not going to leave that $500 in there. I'm going to go and buy a pair of frames or look at that list of Section 213D to use it up. And I have 2.5 months in the following year to submit for reimbursement for those claims I'm incurring in December. So the little kid to the FSAs are the dependent care, the DCAs. So these work exactly the same as an FSA, except that this money that you have withheld from your pay on a pre-tax basis is for childcare or elder care. And so kind of the criteria for that is if they have an EIN, an employer identification number. Really, you can't, unless the home care provider has an EIN, that doesn't qualify. But these are also employer funded. The limits are $5,000 per year per household, and that's tax filing household. So if you're married filing together, that's $501, and you both have access to a DCA. One of you can elect the full amount, or you can both do $2,500. But the most that the IRS will allow you to kind of withhold pre-tax is $5,000. So the use it or lose it rules apply here too. And there's also a rollover. So you can roll over $570 if the employer decides that they want to allow that. The one difference between the FSA and the DCA is that when you would elect FSA, back here, we'll just go back one page. Say I wanted to elect $3,000 over the course of the year. On January 1st, $3,000 is in my FSA account. And then my employer is collecting that over the course of the year. If I spend that $3,000 and then I leave February 1st, the employer has to pay those claims. And there's unfortunately no way around it. Dependent care, the money only is available in the employee's account as it is withheld. So if I'm electing to have $5,000 withheld and it's February 1st, the only thing in my account is what has been withheld in January, 1/12 of that $5,000 in the month of January. That's all I can use. And so if people can afford it, sometimes they use these as savings vehicles. So they're paying their daycare up front, they're having the money withheld from their pay. And then at the end of the year, they'll submit all the receipts and get that $5,000 check for their Christmas fund. Or they could swipe, their card if their childcare provider accepts debit cards at the time of service for whatever they've been withheld that month, or whatever's in the account at that time, and then just pay the balance directly if there's a balance due. Okay, and the last one is health reimbursement arrangement. So a lot of people get the HSAs and the HRAs confused, but they are totally different. So an HRA is a health reimbursement arrangement. It's an employer-funded account. Employees do not contribute to it. Employers, what they do is they determine a set amount of money that they promise to pay their employees who incur medical expenses. And so often what happens is an employer will sponsor a plan. Maybe it has a really high deductible, and they don't want the employee to be subject to that high deductible. So they say, well, you have a $5,000 deductible. We're going to give you an HRA of half that. So you're going to have an HRA of $2,500. And let's say you're healthy and all you need for healthcare that year is your preventive exams and some, generic drugs or something like that. Because you haven't, well, I guess the generic drugs would be an out-of-pocket cost. So let's just say all you got was your preventive exams, your age-appropriate preventive exams, your screenings, your flu shots, etc., and nothing cost you out of pocket, then that money stays with you as the employer. But let's say, they have to go to the ER and they get a bill for $1,500. Based on how you set up your HRA to work, that $1,500, they can use their debit card or they can submit a claim for reimbursement. So they would pay out of pocket, they would submit the claim to the vendor who's administering your HRA, and they would reimburse you, that $1,500. And then at that point, you'd have $1,000 left on your HRA. So these are really great vehicles to use to kind of lessen the burden of the out-of-pocket on the plan that you've chosen. We have a lot of clients that do this. And we typically see that our clients use about 40% of what they promise to pay. You can reduce that even lower if you kind of put a deductible on your HRA. So this gets a little bit complicated and hard to follow, but you have a health plan deductible, but in order for you to access those HRA funds, they want you to kind of spend the first $500. Once you can say that you've spent $500, then that HRA money becomes available to you. And I have a client that the employee has to pay the first $500, then they get $500 from the employer, then they have to pay the next $500, then they get another $500. You can set them, it's kind of complicated. We like to see, first dollar coverage, which means you're going to offer them the plan and you're going to say, we're going to give you the first whatever available on this HRA. If you're healthy as a horse and you never need it, wonderful. You're not out the money, and neither are we. If you need it, it's there for you to protect you from having to pay a lot out of pocket towards the cost of your care. You can limit it to just medical, so just stuff that's tied to their medical plan, or you can open it up to all dental and vision. It's totally up to you. Unused amounts, they roll over, so you can set it up. You say, we're going to give you $1,000 a year no matter what. If you don't use it, then we'll half of that will roll over to the next year and you can accumulate it. It's not as popular because it kind of defeats the purpose of an HRA. You want the money to be there when needed, and if it's not needed, you don't really want it to roll over, but that feature is there if you want it. And the nicest thing about it is it can be paired with any plan. So it doesn't matter if they're in an HSA compatible plan or a copay plan. They can be in any plan at all. And if you want to set up a health reimbursement account for your employees to give them a little something towards the cost of their benefits, if they need them, it's there for you. Both Blue Cross and MEP offer integrated ones. So, the vendors are going to want to make sure that when they see a charge come through on their HRA debit card, if they can identify it by the merchant code that is very clear, yep, this was a pharmacy, it's got to be a qualified medical expense. Say it was a grocery store. Well, you can buy some things that are, Section 213D eligible at the grocery store, but not everything at the grocery store is an eligible expense. So in that case, they're going to want to see exactly what it was for. And the other beauty about these, the integrated ones Blue Cross and MVP offer, is that you enroll them with Blue Cross and they're automatically fed over to the HRA side. You don't have to enroll them into the HRA separately. So they both offer pretty competitively priced. It's like it's $2.50 per employee per month to administer the plan. And that includes all the plan documents that are required to do anything on a pre-tax basis, because these are not taxable accounts to the employee. It's tax-free money that you're giving them to cover their out-of-pocket expenses. So then there's other HRAs. So these are the HRAs that can only be paired with a group-sponsored health plan. Then there are HRAs that can only be offered in lieu of a group-sponsored health plan. And there's two of them. One of them is the individual coverage health reimbursement arrangement. So this reimburses an employee a fixed amount each month for their individual health insurance premium or out-of-pocket expenses. The catch to this, which this was by design, was very intentional because they want to drive employers to sponsor group health plans instead, is if you provided your employees with an ICRA, we call them, they are not eligible, no matter what their income is, for any subsidies on the exchange. So in order to use this HRA, you have to get an individual policy on exchange. But if you qualify for a subsidy, you have to decline it. So it's taking the place of the subsidy again. Remember when we talked earlier about, a contribution to premium of a health plan, the government sees that as their subsidy. It's just coming from the employer versus the government. Same thing here. If you want to give them some money in an ICRA in lieu of sponsoring a group health plan, they're not eligible to take that subsidy. The other one that you can offer in lieu of a group health plan is the qualified small employer health reimbursement arrangement. So we call these QSERAs, and these reimburse employees for out-of-pocket expenses. So like the FSA or the HSA monies, anything section 213D, you can give people money towards their out-of-pocket expenses only. So the thing about this is if they are going out and getting their exchange plan on the individual market, the amount of the QSERA has to be reported and may affect their subsidy eligibility because it is looked at as income there. So it may reduce how much they're eligible for, probably not by a huge amount. But this will basically give them some funds to pay for the cost of their care, however and wherever they get their care. We do not administer either of these. I can make recommendations. You can work directly with the vendor because they're not tied to any kind of insurance. So we will just kind of introduce you to a couple of vendors in the area that will administer them for you. There is a 90-day notice that you have to give in advance of offering either of these. So, you could probably I don't know if you have to start on January 1st, but let's say this was definitely something you wanted to do, you would want to get in touch with the vendors, as soon as possible, because you do have to tell your employees that you're offering it so that they can make informed decisions at their next open enrollment period. Okay, so that was the hard part. The rest of it's easy. Group sponsored dental and vision. So these plans are much more flexible in terms of the benefits and what like price points. So they can be offered on a contributory or a voluntary basis. Basically what that means is contributory is when the employer contributes towards the cost of the plan. You pay 50, they pay 50, or you pay 80 and they pay 20. A voluntary basis means the employee is assuming, in most cases, 100% of the cost of the plan. You're just making it available to them. And so both dental and vision can be offered in both ways. And the premiums are different based on how you offer them. So I just did this quick analysis yesterday. The cheapest, least expensive plan, so this would be contributory, the smallest network, the highest copays, is $27 a month for a group plan. That's as an individual. And then the most expensive plan I could see out in the open market was $56 a month. So this would be a voluntary plan with no copays. The lowest deductible I could find would be around $56. Same thing for vision. The lowest I could find out there, vision is very cheap, $366, but you can go up to all the way $15 a month per single enrollee. And so you would roughly double those amounts for couples. And then it would probably be, I would say 60% more, 70% more for a family. Again, we can quote this all for you, but there's a lot more flexibility to get to a price point that you can afford, or you think that your employees can afford. Because there's so much flexibility in the plan options. So like I said, we can add deductibles or remove them. We can add copays. We can add big copays, little copays. We can, for the dental network, we can choose to offer on a PPO network, which is a restricted network, versus the PPO plus Premier network, which is the broadest network. There's optional coverage that you can carve out or include if you want to, like orthodontia is the most popular one. And then there are different levels of materials allowances on vision benefits. So, some plans have $130 allowance towards frames or lenses, where other plans have 180. Obviously, the plan with the $180 allowance is going to have a higher premium. And the nice thing about the dental and vision is that the owners of the business can be the only enrollees. So there are participation requirements. Most of them require 2 enrolled. Some of them want to know how you're offering it, like if you're going to contribute or if it's going to be voluntary. If it's going to be voluntary, they want 10 enrolled. If you're going to contribute, they want 2. So I would say most of the time we're looking for 2 enrolled. However, you and your spouse can be the only 2 enrollees, and you can offer this group plan. So you can say that you offer it. And then we've got group sponsored life and disability. So this is life. The first column is life and accidental death and dismemberment. This is employer paid. There is an employee paid option too that we'll get to on the next slide. But typically, this is 100% employer funded. You're going to give anybody who's eligible, they have to work at least 17.5 hours a week to be eligible, but you can kind of set your threshold higher than that if you would like. And it's guaranteed issue. So people who have, conditions that prevent them from getting term life insurance on their own, they at least can get some life insurance through you while they're working with you. So we see them, from $50,000 or higher, and you can give your employees the option to buy it up in increments of $10,000. They pay the premium on that. Or some cases they will do kind of 1 times their salary. For higher compensated employees, they'll do 2 times their salary, things like that. Short-term disability. So this is a benefit that kicks in to replace the income for somebody that can't work due to illness or injury or pregnancy. They consider pregnancy illness. Wait, is it illness or injury? I don't know. I'm sorry, but it fits in one of those categories. It doesn't make any sense. So the short-term disability benefit usually kicks in on the 1st or the 8th day. There's usually a waiting period. Adding a waiting period will make it less expensive because they have to wait those 8 days. And if they're still disabled at that point, then they qualify for the disability. And it typically pays, 66% of their weekly salary, and typically lasts 10 to 12 weeks. And then if they can return to work sooner, obviously they would return to work. If they are still deemed disabled and they have doctor's notes and they've been through all of that claims process, and you have a long-term disability benefit, that's when long-term disability would kick in, usually after, or sometimes it's after a 6-month waiting period. And this is based on 60% of the monthly earnings. So it's a little bit different of a calculation. I have not seen too many employees move to a long-term disability. It just doesn't happen that often. But it is, a good benefit to have to protect anybody who does become disabled long-term. They could stay on your policy even after they've kind of left your place of employment. If they were approved for long-term disability while they were still kind of employed, they can stay on there indefinitely. So these are, when we quote these, we need a census. We need to know, the age and gender of your employees and their annual salary, so that the carriers can base kind of the rates on the demographics of your group themselves. So if you're ever interested in looking at something like this, we're happy to quote that out for you, but we would need some information from you in order to provide some numbers. And you can offer any of them. You don't have to offer all 3. We often quote all 3 just so that you can see them, but you can say, I'll just take the life and long-term disability, and we'll let the employee pick up the cost of short-term disability. So then there's voluntary benefits. So these are 100% employee funded. Think of like the Aflacs of the world, or Colonial is a vendor that we like, a carrier that we like to work with a lot. So they offer dental, and it's different than the like Northeast Delta Dental. That's a typical like standard insurance plan. You go, you show your card, they tell you how much you have to pay. The dental plans through, Colonial or Aflac or any of the other carriers that offer these, they're reimbursement plans. So they will say, we're going to pay, 100% of what's usual and customary in your area. And so you go, you have your dental services, then you submit you pay out of pocket, and then you submit a claim to your insurance company, and they will reimburse you based on what's usual and customary in your area. So it works a little bit differently, but it works great for some of our clients that do have it, especially if they live somewhere where there aren't a lot of dentists in network. There is no network. So go wherever you want, pay out of pocket, and then submit a claim for reimbursement. You can also get life insurance this way. So you buy it in the same way, $10,000 increments. You can get it on your spouse and your children as well. It's all based on your age. So they're age banded. And you would pay that premium. You know, you could either have it set up to come out of your paycheck, or as the employer, you could say, nope, we want you to just we're going to make these plans available to you, but you make the payment arrangements directly with the insurance company. So that's called direct billing. So you typically would put a debit card on file, or, you know, bank account information on file. Once a month, they would just deduct your premium, which makes these policies portable. So they get access to it by working through you. You have no, commitment other than if you decide to set up the payroll deductions on their behalf. Otherwise, you're just making it available, which they wouldn't have access to otherwise. And the last part is the premiums are based on the employee's unique salary. So it's kind of hard to tell you how much it would cost. But generally, let's say, a 40-year-old woman who's looking for short-term disability, who has a salary around $45,000 a year, I would say she could expect to pay $40 a month, $45 a month for that short-term disability coverage, which would give her, the 66% of her salary for up to 12 weeks, something like that. But really, we need to plug in all of those those details to get to that weekly rate. And often when we do launch employee benefits with any of our clients, we will bring in the rep from the insurance company who has all of the tools and can just do it on the fly and tell you very quickly how much it'll cost every specific employee. So we try to make that simple. And that concludes all of my employee benefit, even though there's plenty more. There's pet insurance, there is tuition reimbursement programs, there's all kinds of stuff. But those benefits usually don't kind of get introduced until after these other ones do. But you don't have to. You can go out of order. And I welcome you to visit our website, reach out to me anytime if you have questions about any of the other benefits that we haven't covered tonight. I'm happy to talk to you. And now I'm going to turn it over to Steve, who's going to get into the world of retirement planning benefits.
All right, great. Thank you, Jessie. I think you can all see why Jessie and our select business unit are very busy people helping lots of employers throughout the state, because they know just a tremendous amount. You can just see the variety of options and solutions that are out there to help out your staff and your employees. Let's just shift gears briefly and talk a little bit about retirement benefits, which again is one of the things when you look at your budgets going forward. One of the things that you can use to help your staff members out is to look at retirement savings. And here again, there are different levels of solutions based on your individual business and the number of employees that you have. I would say for the vast majority of small employers, either the SEP or small employer plan or the simple IRA, generally speaking, are the most common retirement plan solutions. I'll be talking about those options in detail. For some larger employers, many times you will make the jump to a 403B or a 401k plan. And 401ks and 403Bs are a little more involved. They're a little more costly. Of course, the 403B is for a not-for-profit entity, and the 401k, generally speaking, is for a for-profit entity. For some of you, you may decide to expend your available budgets to help your staff members buy health and dental and vision and all of these other programs, or funding an HRA solution. And in that case, for your staff members, it could be that the most efficient option for them are individual options, where someone goes out and buys a traditional invest in a traditional IRA or an after-tax Roth IRA. And so that's currently that could be the solution that employees are using. Jesse, next slide. One more, there we go. So with respect to, and again, I'm going to show you a comparison chart of the SEP, the simple, and the 401k. But this, quite simply, the SEP or the simple IRA plan, in my belief, and I do this for a living, and I get paid for doing this and advising people, the most efficient way to do this is direct online or through the phone. In other words, go directly to the vendor. No need for a middleman or a broker, so that you can get a reliable, low-cost, efficient solution for you and your staff members, if in fact the simple IRA or the SEP IRA is the best option. Same thing goes with individual options. Most often these days, investing in a traditional pre-tax IRA, which allows you to deduct the amount that you contribute from your taxable earnings for a given year, or contributing to an after-tax Roth IRA on an individual basis. In my opinion, for most people, buying these direct from one of the large mutual fund companies like T. Rowe Price, Fidelity, or Vanguard, and there are many others out there, that is the most efficient way to buy those. Keep in mind, when we look at the pricing of retirement plan options, it is important to understand what the fees are and if there are any commissions being paid to the intermediary. Quite simply, there ain't no free. And so where are things low cost and efficient? If it's a small plan or an individual plan, it's by going and buying direct to the vendor. When you get to a 401k or a 403b, I will tell you it's more complex. You do need the help of an advisor, and you do need the help of an administrator, and you will pay administrator oversight fees for it, but they are much more complex plans. There are also plans that allow you to defer higher amounts of money and customize how you design the plan, how much you match, who becomes eligible for the plan. So again, you move from the very basic individual option to the SEP or the simple, and then graduate to the 401k or 403b. Jesse, next slide. So not to let Jesse be outdone with a complex grid of options lined up, but here's again, we're going to email you the presentation. Here is the SEP IRA versus the simple IRA versus a 401k 403b plan. So with the SEP IRA, the first line is an employer contribution required. And so again, with the SEP IRA, there is no required employer contribution, but there's a discretionary contribution of up to 25% of the compensation. With a simple IRA, it's a dollar for dollar match, and an employer contribution is required. So with the simple IRA, you can either do a dollar for dollar match up to 3%, or you can give every single employee 2%, whether they defer their own money or not. So again, just to review, with the SEP IRA, the employer, there is no employee contribution into the plan. The employer contribution is the same for everybody, and it can go upwards to 25%. So based on someone's salary, the contribution is upwards to 25%. When are SEP IRAs usually used? Oftentimes with a single employee company or with a very small, closely held company. The most common option for most of your organizations is in all likelihood going to be the simple IRA, and then potentially as you get larger, or depending on the number of employees, making the jump to the 401k or the 403b plan. So again, with a simple IRA, the employer must contribute, and the employer must either do a dollar for dollar match up to 3% or give every employee 2%, whether they contribute or not. You move to the 401k or 403b plan, you can set the rules as to who contributes what. Employees can contribute, the employer can contribute. There's no set percentage amounts. There are some limits that you'll see, but you can literally have a discretionary match. So, for example, you could set up a 401k plan and say you can, as an employee, you can save your own money into the plan, and we have a discretionary match. And at year end, you can look at your budget and say, oh, we've got some extra funding that's available. We're going to make a discretionary match of dollar for dollar to 2% or dollar for dollar to 3%. Or we're going to give everybody across the board a 3% contribution. So you have added flexibility when you make the jump to the 401k or 403b plan, in that contributions by the employer can be discretionary. They don't have to be locked in. With all three of these plans starting in 2023, you can do both Roth after-tax contributions and pre-tax contributions. Up until this year, simple and SEP IRAs only allowed pre-tax contributions. And more, we're seeing employees, especially younger employees, wanting to contribute and benefit from after-tax contributions. The 401k and 403b have always allowed since 2007, have allowed after-tax contributions. One of the reasons why you may want to make a decision between a simple IRA and a 401k would be how much money you want to set aside or how much money you want to allow employees to contribute to the plan. With a simple IRA, if you're under 50, the employee can only defer up to, it's a big maximum, but they can only defer up to $15,500 a year, unless they're over 50, and then they can put an extra $3,500 in. With a 401k plan, there are higher limits. So with a 401k plan, someone under age 50 can put away $22,500 a year, or if they're over 50, they can set aside and defer their own money, their own compensation, up to $30,000 a year with that over 50 catch-up. So many times, a small employer will elect the 401k solution because they're looking to, the business owner is looking to set aside bigger dollars as an employee, and also potentially as an employer match or contribution. Vesting is the ownership of the employer contribution. And with a SEP IRA and a simple IRA, it's 100% vested. Someone comes to work for you, they work for you for a year, you give them a dollar for a dollar match of up to 3%. They leave in month 13, they take every nickel of the match with them. It's 100% theirs. Again, with a 401k or 403b plan, if you wanted to have a schedule of ownership, you could actually build schedules of ownership all the way out to 6 years. So you could say, we're going to give you a discretionary match. We're going to give you a discretionary contribution. And guess what? Until you've worked here for a full 6 years, it's not 100% vested. It has a graded ownership schedule over those 6 years. Jessie, next slide. So, with the SEP IRA, there are some testing requirements for the IRS and the Department of Labor. With the simple IRA, no requirements. What the simple IRA is essentially is it's a grouped version of a traditional and Roth IRA rolled together. So there's no testing requirements, no compliance requirements per se. With a 401k plan, there is year-end discrimination testing. There's a 5,500 that's filed. You do need a third-party administrator. There are fees to have that third-party administrator who makes sure that you stay in line with IRS and Department of Labor standards. So there is a little bit more when you make that leap to the 401k. In terms of investment options, with the SEP or simple IRA, usually you're talking to one fund company. I'm going to share some names with you. And so you have a single fund family. So you'll have, for investment options, typically the age-appropriate target retirement fund from that company, and then a menu of all that company's investment options. If you want more investment choice and more investment selection, generally speaking, you're going to migrate to the 401k solution, which would let you pick not just from the fund company, but from a broad array of different mutual fund options. The simple and the SEP, again, it's a very basic contribution. Like, for example, as you recall, with the simple IRA, you either give everybody 2% or it's a dollar for dollar match up to 1%. The 401k plan or 403b plan for a not-for-profit, you can actually have what's called discretionary profit sharing. So if you have excess funds, this is not generally a problem that most employers have, but if you have excess funds, you can actually make a special additional profit sharing contribution and distribute those funds to employees. And you don't have to distribute the funds to employees evenly. You can give, if you're the owner of the child care center, you can give most of the profit sharing to you and give lesser amounts to the other employees. So again, making that jump to the 401k adds more flexibility. I will say, generally speaking, most employees or candidates out there, they don't ask, do you have a simple IRA plan? They always ask, do you have a 401k plan? It doesn't mean that the simple IRA isn't the right solution. It's just the most common group retirement, as most larger employers offer them, is the 401k solution. So again, there are differences. Jesse, if you move to the next slide, I'm going to give you my opinion that, and I'm making an assumption in terms of, I'm assuming that most of you have fewer than 25 employees. If I'm wrong, we can talk more about it. But I believe that as a starter plan, the best solution and the lowest cost solution that will be good for the organization in terms of affordable, also good for the employee in terms of giving them an affordable way to invest without too many fees and not too many commissions, that the simple IRA is the best possible solution. To set up a 401k plan or a 403b plan, the administrative costs alone on an annual basis for an employer with 10 employees is probably upwards to $7,000 a year to administer the plan, to pay the various vendors that are involved. Simple IRAs run on a calendar year basis. So you would set one up now for January 2024. It's too late to set up a simple IRA for 2023. If you don't have a plan now and someone wants to save for 2023, you need to do it through individual traditional IRAs or Roth IRAs. With a simple IRA, you can determine who is eligible for the plan. What's the eligibility? It's not 30 hours a week. It's not full-time, part-time. It's, do we allow people that make less than $5,000 a year? Do we allow them to participate in the simple IRA, or do we exclude them? Most of the simple IRAs where I've given guidance on, most people say, you know what? If someone wants to contribute and they make less, they work part-time for us and they make less than $5,000 a year, let them participate in the plan. Yes, I'm obligated for making a dollar for dollar match up to 3%. That simple plan, but it's on a small base of money. It's not much. It's a nice benefit. And so generally speaking, I see plans that are set up where everybody, even if they make less, if they don't make much money because they work part-time, they're eligible for the plan. When you set up a simple IRA, you can set it up to allow multiple vendors or one vendor. Make your life easy. Use the form 5305 simple and only allow one designated vendor, because you have to send the contributions to these vendors out of your payroll system, and you don't want to send money to everybody's individual IRA account at the brokerage firm down the street or some other company. Pick one vendor and only send it to that one designated vendor. I think the simple IRA is a self-service solution. There are very minimal costs when you go directly to the large mutual fund company. You don't need an advisor like Steve to help you. Honestly, there is, if you just don't, there's no need. They're not that complex. There's not that much help that's needed. So that you don't want to have fees coming out of the small amount of money that your staff members are putting into the plan to save for retirement, or the match that you're making. You want to be able to buy direct. And again, what's your responsibility if you set up a simple IRA? Generally speaking, it's an online portal. You'll need to submit regular contributions. So if someone decides they're going to save 10% of their salary and put it into the simple IRA, you're going to withhold that 10%. And then on a regular contribution basis, for each payroll, you're going to submit the contributions, what that employee saved, plus the match, and submit that. And again, it's an ACH connection and regular payroll. You have to add new employees, and you need to terminate former employees. And generally speaking, this is all online enrollment. So for the most part, once the plan's set up, no paper forms. And these days, we want to avoid paper forms. I think the dollar for dollar match of 3% is reasonable. I think that's sort of the gold standard that's out there for larger employers. Oftentimes there's a slightly higher match that's out there, but this is a good competitive match and it's reasonable. What I would do is I would run the match based on your gross payroll. So if you look at your gross payroll for the year, what's 3% of that? That's going to give you the worst case scenario for a budget hit. If your gross payroll is $127,000, what's 3% of that? And that's the worst case scenario in terms of your exposure if people contribute to the plan and contribute at least 3% or more. So you're able to budget what your expenditure is with respect to the match. And then as if your organization grows, if you have more employees, if you want more choice, if you want higher contribution limits, if you're the business owner and you're looking to catch up on retirement savings and you really want to sock away as much money, as much of your compensation as possible, you may want to graduate to the 403B or the 401K. And you do that when you're ready. And if you have questions, does it make sense? I'm happy to have a side conversation with you about it. Just keep in mind that if you start a simple IRA, the only time you can switch from a simple to a 401K or 403B is January 1st. So when do you have to make your decision to make the leap to the 401K? You have to start talking to someone like me in September or early October, because there's ramp up time, there's planning, there are notices that are required when you make the switch from a simple IRA to a 401K down the road. I'm going to give you some names. It'll be in the presentation that we email out to you. Oh, go back one slide, just 1 second. So the last bullet point here is that so we do this for a living. We manage about 125 401K and 403B plans throughout Vermont and into New Hampshire. For small employers, I will tell you that I have found personally that T. Rowe Price is the lowest cost vendor as the record keeping solution. And so if you're, and their platform looks and feels a lot like their simple IRA platform. So if you're going to start somewhere and think you're going to graduate to a 401k, you may want to look at least consider the T. Rowe Price option. If you've already got a 401k or a 403b in place and you've never had an objective third party take a peek at it, I'm happy to take a peek at it, just look at it and say, yeah, this looks great, this looks affordable, or I might highlight a couple of things that with the plan design or the cost of the plan or the investments in the plan that you may want to revisit, and I'm happy to do that. All right, now I'm ready for the next slide. So you can research and Google simple IRA anywhere. And there are lots of solutions out there. Here's the one over my 25 years of working in this business that I've sort of found works the best. I like T. Rowe Price for the simple IRA, and I've helped a couple of employers early on get that set up. Fidelity does a very good job with simple IRAs. Vanguard also does a good job. You can also buy all three of these direct without an independent broker that's going to take commissions. These links, if they're live in the presentation, these links, just type in Small Business Solutions T. Rowe Price. These hyperlinks will bring you to their small business page, and it will give you a comparative tool. Sure, Jesse, you want to hit it? Nope, will it launch? So what you'll see is, and it's loading. What you'll see is they actually have a tool that you can. It's an algorithm, and it basically. It's probably not going to load, Jesse. That's okay.
All right, sorry about that.
It will say, okay, here's a SEP, here's a simple, here's a 401k, and it will ask you a couple of questions. And to the extent, if you scroll down a little bit, see, you can follow this little chart and say, how many employees do you have? Do you want to make contributions? Do you plan to save more than 25% of your compensation? And it'll bring you down. And as you see the blue dot at the bottom, it'll say, if it's just you, an individual 401k or a SEP IRA or simple or small business. So they're all three websites have great algorithms. All right, Jesse, let's go back to the presentation. We love to look up things online and research things online. I will tell you that this is one of the situations where sometimes picking up the telephone and calling the call center at T. Rowe or Fidelity or Vanguard and talking to a qualified rep can help you. It may be able to help you save time and doing the work on your own. The last link here is the simple IRA brochure that the government publishes. And I just find it's a good resource to understand the simple IRA option. All of these companies have their own brochures, their own information online. But again, resist the urge to just do all the research online and think about just picking up the phone and calling the call center. I think, Jesse, that's my last slide.
Yep. Now we're at questions.
All right. Any questions?
So this was amazing. Thank you so much. There are a couple questions that I want to get to in the chat for both of you, I think. But I'm just so grateful for all this information, because I think one of the things that leaders of early childhood businesses are thinking about right now with our new law and the new income that will be coming into programs is that we can actually look at compensating and supporting our early educators, our employees, as professionals. And I just think the idea of young professionals going into the field of early education and being supported with benefits and a retirement, which sometimes doesn't feel so important to young employees because they don't think they're ever going to retire, just having it as an automatic part of working in an organization can really make a difference in folks' futures. So I just am so thrilled with this information. And as Stephen and Jessie both said, we will get the slides and the recording out to you. But now that we've got a little time and we can follow up, there were a couple of questions. One was early on, Jessie, I think this was for you around, you had said if programs are offered a certain healthcare benefit, then they would no longer qualify for subsidies. And the person is asking, why would we want to put employees in a situation that puts them in a worse place? And I didn't know if you wanted to respond to that.
Sure, I can expand on that. And this is a conversation we have with every small business that wants to begin offering medical. If their employees have become accustomed to, getting on their spouse's insurance, or they're purchasing their own insurance on the exchange with subsidies, it's impossible for you to know how much of a subsidy they're getting unless they just disclose that to you. You know what they're earning and what their annual earnings are by their wages, but it's based on, their subsidy is based on their tax household. So, the number of dependents, if they're married and filing jointly, that person's income is also reflected in their subsidy amount. And so what we do is recommend that employers ask their employees, do a survey and just say, if we were going to offer a group sponsored medical plan and we were going to contribute roughly this amount, it doesn't have to be the exact amount, we were going to give you this much towards the cost of your plan each month, would that be something of interest to you? And we have some survey templates that I'm happy to share, and you can, just collect information that way. I would say is kind of the best way to see, is that a benefit that's really of interest? If it's not, and they, they're on Medicaid or they have coverage through their spouse, which is wonderful, and they're not willing to walk away from that no matter how much, or if what you can afford to contribute is way, significantly less than what they're getting as a subsidy, then maybe health benefits isn't the first place to start in kind of offering an employee benefits program. But it really is impossible to know, and the system is set up to drive employers to sponsor coverage. So you may have some employees, if you decide to sponsor a group plan, some employees may lose out on the richness of their subsidy that they're getting as an individual. But hopefully most of your employees will be gaining something.
Thank you. And then there was a question about the cost for offering premiums, paying for premiums for healthcare plans. And I know that that's not easy to answer in a general way, but can you go ahead.
Yeah, sure. So these are the monthly premiums. I know sometimes people think that they are yearly, but these are monthly premiums by what we call tiers. So that's how you enroll, whether you're enrolling just as a single, as a couple, as a parent with a child or children, or as a family. This is the monthly premium by plan and by carrier. So these are the MVP rates right here. I'm sorry, the Blue Cross rates are first, and then the MVP are second. These are the exact same plans, and you'll see that MVP is less expensive overall. They were much less expensive a few years ago, but they have become more close in price than they have been in the last 5 or 6 years. So these are kind of the premiums, that the full monthly premium. So if you were to sponsor a group plan, if you were to work with a broker like us, we would really want you to see, pledging at least half of the bronze. So, 630, 640, that would be 325, 350 is like what we like to see the employers contribute. Keeping in mind, because you are contributing, unless it doesn't meet that affordability test, you're taking away the subsidy from the government that the employees are getting on the individual exchange. So if you wanted to kind of step into offering group benefits, you want to make sure that you're contributing enough to make it worthwhile for the majority of the people that would no longer be eligible for their subsidy.
Great, thank you. This one might be for both of you. Premium aside, how much should an employer expect to pay to offer health insurance for employees? And similarly, what's the cost to an employer of offering a simple IRA outside of the contribution. So in addition to the premiums that these would cost, is there a sort of service charge, I guess?
Jessie, do you want to go?
Yeah, sure. I'll speak to the medical piece. So on exchange, I left this out because I just wanted to kind of be educational and not too salesy. But when the Affordable Care Act was passed and the Shumlin administration kind of moved all of the small businesses and individuals into one of these plans on the exchange, they carved out broker consulting fees. So before that, you could go out and you could choose any broker that you wanted to work with, and they would help you get your plan and manage all of your compliance with that, and the enrollment and the setup and the ongoing issues that you may have, and the renewals. They would do that all, and they were compensated by the carrier. Since 2014, we have not been able to be compensated by the carrier. It's prohibited. And so we have, invoice our clients directly. Our fees are $20 per enrolled employee per month. So it's not eligibles, it's just the ones that are enrolled. And that includes all of our services for getting your group plan established, educating the employees, getting the enrollments over to the carriers. We would serve as your intermediary, so you don't have to work with the carrier directly. You work with us if there's a problem. We will get the problem solved on your behalf. We have member advocate services. So if one of your employees has this complex claim issue that they don't understand, we have somebody that can kind of walk them through their next steps to getting that resolved. We will help you stay in compliance and give you all of the notices and paperwork and all of the steps and things, the additional things that come along with sponsoring group medical benefits. You can also choose to self-administer. So you want to offer a group plan, call up the 1-800 number for Blue Cross or MVP. It's just you have to do all of that kind of legwork yourself, and ensure that you remain in compliance on your own. So you can do it one of two ways. All of the brokers are going to charge you because we can't get paid by Blue Cross or MVP for our services. So that's that. And then Steve.
And then for simple IRA plans, generally speaking, it's about $20 per employee per year. So per account that has less than $10,000 in it, which to begin with, that's what will be the case. The fee is about $20 per participant per year. Keep in mind that most simple IRA platforms, they are the funds that are being used are the funds of the companies. It's Fidelity funds, it's all Vanguard funds, it's all T. Rowe Price funds. So they're happy to have the money invested in their investment options. So very minimal fee, not much administrative cost at all for a simple IRA. What you need to be wary of with a simple IRA is, what's built in. So if you do work with an individual broker or advisor, just know that they will pick a share class of investments like an A share that will pay themselves for doing the work, and they deserve to get paid. But if they're going to get paid, then you may want them to do some education for you or do some outreach. Note that most advisors will then potentially try to cross-sell other services, but an A share of a mutual fund at, say, American Funds in a simple IRA, if someone invests $100, the first $5 goes to pay the commission. Doesn't go into the account, it goes to pay the commission. And so now only $95 is being invested. And then on an ongoing basis, it's a quarter of a percentage point. So it's a small amount. Again, I think the simples are simples, and you can, generally speaking, go direct. But if you have someone in your local community who's an advisor, who's a broker, who's your own advisor, and they're willing to help you and set up the simple IRA, leverage them, take advantage of their help. And again, generally speaking, they're going to get paid from the funds. That cost is built into the fund.
Thank you. Tessa, you have a question? Go ahead and unmute and ask it.
Hi, yeah. So we're a new program that's opening, and one of the things we're kind of exploring is a cafeteria option, and it wasn't something that I saw, and our question is really around like legality of what that can look like, and our hope is really to have like an employer given chunk of money that it kind of sounds the closest to an HRA. So essentially having a lump sum of money per employee per year that the employee submits reimbursement at the end of each month or whatever to get back for health related expenses. So for my kind of what I've understood is to have a true like HRA, you'd also have to have a group plan. And I think in our current scope, it's not an option. So it's our attempt at doing something. But our hope was also to include like reimbursement for childcare. So kind of a combination of the dependent care, and the HRA. Is that legal? Is that a thing?
So a cafeteria plan is where the employer, instead of saying, we're going to give you, $300 to enroll in the health plan, and we're going to cover 50% of your dental, and we're going to cover 100% of your vision, they're going to say, we're going to give you, this much a year to apply to the insurance plan of your choice that qualifies. So the cafeteria plan only allows you to put pre-tax money that the employer is pledging towards an insurance benefit that qualifies. It's usually medical, dental, and vision. And there may be some others. I don't know them off the top of my head, because cafeteria plans are really administratively complex. There's 1,000 different ways that an employee could spend their $5,000 that the employer offers them. And they all still do require that you have kind of a group medical account, a group dental, a group vision. If they want to put all of their $5,000 towards their health insurance, they can. You have to figure out what their contribution is. If they want to split it up between the 3 benefits, they can do that as well. So the cafeteria plan is more, it's like that premium only plan document. You'll need a document like that, but also that captures all of the other benefits that employees can pay for with pre-tax money. So they get to choose how they want to apply that pre-tax money. The HRAs are set up in a way where they are a promise to pay. So yes, you could do a QSERA, which is you could allow medical, dental, and vision expenses. And then I don't believe that you can set up kind of, only this much can go to dental, or only this much can go to vision. It's whether you allow all 3 categories of benefits or not. Dependent care would be a separate vehicle that it's not considered Section 213D. So any funds in the QSERA cannot be applied towards dependent care. That would be setting up a separate fund altogether. And there is no way for an employer to give dependent care funds on a pre-tax basis.
Okay. Someone wrote maybe a living stipend would be better. Give employees X amount of month or year. No need to say what it's for. Yeah, that might, yeah.
I mean,
it's all super helpful information.
Yeah, that's kind of grossing up their salary for that. It's going to cost you as the employer more in the long run, and the employee, because you're going to get taxed, Medicare and FICA taxes will be assessed just as regular income if you go that route.
Okay. All right. Thank you.
Mm-hmm.
We are coming up on 7:30. This has been amazing. I don't know, Jessie or Steve, if either of you have any parting comments for the group. Just to remember, I will send this out to all who signed up for this session tomorrow. I'll send the PowerPoint and the recording. And there are some links that you can follow up on within the documents that oh, and there was one last thing, Jessie, I forgot to say that was in chat, that people would love the templates for the survey that you mentioned.
I saw that. Yep, I'll send that over.
Okay.
Mm-hmm. Right.
Anything else?
No, thanks so much. Let us know if you have any questions.
Yes.
Thank you both so much. This was amazing. I thank you all for taking the time out of your evening to join us. And yes, follow up with any of us. If you have questions, you'll hear from me tomorrow morning. Thanks, everybody. Have a good evening.
Bye-bye.
Good night.